Hi, everybody. This is Jack with the Wealth Triangle Report. And what I'm going to do today is explain to you what the Wealth Triangle is and why people use it and why this is probably going to be the most profitable strategy you use in the next 12 months. So the first principle that I want to get across to you, there's several principles and concepts that you need to understand in order to fully grasp what we're going to do. But the first one is the power of compound interest. Now, I've got probably 200 or more quotes from the most wealthy people in the world. And all of these quotes have to do with what they've said about the power of compound interest. Everybody from Albert Einstein to Warren Buffett to people you never heard of that are billionaires. And the way this works is the power of compounding works by growing your wealth exponentially. It adds the profit earned back to the principal amount and then reinvests the entire sum to accelerate the profit earning process. This is how the elite make massive wealth. Now, we're going to do a deep dive into that, every component of adding the profit earned back to the original principal amount. And then we're going to reinvest the entire sum and accelerate the profits by cash flowing the asset, right? This is all going to make a lot more sense as we go through it, which is why I'm excited we're going to be doing it for 12 weeks. But that's what the Wealth Triangle is. It's a great way to build wealth in a short period of time without focusing on just buy and hold strategies, all right? Now, here's a diagram that perfectly explains what we're going to be doing here in just 3 steps. We're going to buy stock and start receiving a dividend if it pays a dividend. If it doesn't pay a dividend, that's fine. In step 2, we're going to cash flow that asset. Original Wealth Triangle is to buy an asset, to cash flow that asset, and to use the cash flow from the asset to buy more of the asset. We're going to apply this Wealth Triangle philosophy to investing to get extraordinary high returns. All right, we're going to start by buying a stock that does or doesn't pay a dividend. We're going to increase the cash flow on that stock by selling call options, and that's going to bring in 12, 24% or more per year. And then when we sell those call options, that cash hits our account immediately. So what we're going to do then is buy more stock with the dividend and the option income, aka compounding. So this is where you're going to be picking up stock at no cost, right? You're going to be spending the cash flow to buy more stock, and that's going to grow your portfolio exponentially, especially considering we're just going to start off with one small block of 100 shares of stock, or 200 or 300, but at least 100. So that we can sell one call, because each call option is worth 100 shares, controls 100 shares. And we're going to take that money and buy back the same stock. And it's going to do a couple things. It's going to lower your cost basis on the stock, as I'll show you, and it's going to add to your portfolio. Now, here's an example where I did this with Apple. We're going to continue to do this with Apple because I'm going to have my own money on the line with you in this. So I want to just show you what's happened with this with Apple. Now, there's one component I left out here, but I just want to show you a couple of things. Now, my cost basis in Apple was originally $121.24. So what I did was I bought the stock, and then I sold an Apple call with a strike price of $135, and I received $239 per contract. Right? If you did one contract, it's $239. If you did 10, it'd be $2,390. Right? You can do the math on that, and we'll have an options class on that too. But by selling the $135 strike price call option, what I've done is I've set myself up to receive $239 immediately. Now, this call option, it's just a contract, and what I've done is I've sold someone the right to call the stock away from me at $135 for an option that's going to expire here in November. Now, if Apple is above 135, then he's going to call it away from me. If Apple is below 135, he's not going to call it away from me because he could go into the open market and buy it for less than that. It's just that simple. So in this case, I did not get called out because Apple at the expiration date was below 135. So the next Monday, I sell another one. Same strike price, 135 strike price for another month out. This time I collect 365. Now this amount is going to vary depending upon what the actual price of Apple is when you do this trade. But here I bring in 365. Again, at 135, you can see this is the 135 price level is right here. This is the stock price. It's below 135, so I'm not going to get called out. Again, I just collect this money and I do it again the next month. I pick a lower strike price, this time 134. You can select any strike price you want, but you always want to have it over the price you pay to the stock, right? I collect 235. I don't get called out at 134, so I sell a 140 call. The stock bumped up a little bit. I get $340. I don't get called out. I sell a 130 call, and the fifth time there were two more I couldn't even fit onto this chart, and I eventually got called out around 140. But look at what happened here. Now I had this stock at 121.24. That was my original purchase price. If you bought that on margin, that would be $6,512. If you paid cash for that 100 shares, it'd be $12,124. Now you can do this on cash or on margin. You can do it in an IRA or a regular account. It doesn't really matter. You're going to get a higher return if you use margin. But if you're doing it in an IRA like I am here, it doesn't matter. You're just paying cash for the stock, full price, and that's cool. Because every time you sell one of these calls, you're lowering your cost basis. So look what happened. I owned it at 121.24. I sell a call, I collect $239. That lowers my cost basis by $2.39 on the stock because I have 100 shares. I do it again, I lower it by $365. I do it again, I lower it by $235. I do it again, I lower it by $340. I do it one more time, I lower it by $1.77. Now my cost basis at this point after selling 5 months of covered calls is down from 121.24 to 110.03. So just imagine if you get called out two more times on your seventh month, you get called out at, let's say, 140. All right, your cost basis might be around $105. To get called out at 140 on Apple, you'd make the biggest profit on Apple anybody ever made, especially considering the stock just went sideways. Right? So you're making money while the stock is just going sideways. Right? That just, it's lowering your cost basis. If you do get called out, you're going to make a monster profit, probably the biggest stock trading profit you've had. If you don't get called out, you just continue to do this. Now, I know a guy that's done this so many times on Apple. His cost basis is zero. Now, I want to add one more really killer component to that is because what we've got to do is take this cash flow and buy more Apple, right? So what's interesting, if you got $239 here and the price is only $133, you can buy one share of Apple here. You buy 2 shares this time. You buy another one. With the cash left over, you could probably buy 4 here, right? You'd be up to 4, maybe 5 or 6, maybe 7, 8, 9, maybe 10 shares in a 7-month period that you've picked up. So if you were to get called out at 140 and you have 110 shares of stock at a cost basis of 105, 10 of those shares cost you nothing that you got called out of at 140. Now you can pick higher strike prices if you don't want to get called out. But if you do get called out, you make the difference between the strike price and your cost basis. And that's a huge profit. And if the stock pulls back a little bit, you can always get back in, right? So even if Apple doesn't pull back, I get back in because as you'll see when we look at a longer time frame of this is one of the best ones to do it with. Use the wealth triangle strategy. So we bought Apple. We're cash flowing Apple in step 2, right, of the wealth triangle. And then we're using this money to buy more Apple. So that's going to build you a monster position faster than you would normally think it would. And the profit on that is going to be exponentially higher than what it would be had you not done this. So just by adding 2 little tiny steps to a normal trade, you've set yourself up to get an exponentially higher return. Now, what are those two steps, right? The normal step is just buy a stock. That's what buy and hold people do. But we're not going to do that. We're going to add two steps. We're going to cash flow that asset, which is the stock, and we're going to take that cash flow and buy more stock. And by doing that, we're going to get all these benefits. Monthly cash, right? You're going to use that to buy more stock. You could spend that part of that if you want. You're also going to lower your cost basis on this. And this is why the CBOE says that selling covered calls has less risk than owning the stock. They said that in a letter to the SEC. Imagine people think that options are risky, and they can be, but if you use them correctly, they can be a real huge profit boost. So this is great because, again, Apple did not have to go up for us to make this big profit. And it's higher than this now, Apple. I'm making this on November 19th. We're launching the class, the Wealth Triangle Report class today. So I'm just bringing you up to date on what we're going to be doing and give you an overview of how this works, right? Again, so this is what we'll be doing. We're going to be finding stocks. Now, I'll find these stocks for you. I'm going to send you the alerts. I'm going to tell you which stock to buy, which options to use, the exact strike prices, the whole 9 yards, so you won't have to worry about that. And I'll tell you what stock to buy, and I'll give you the alert on that twice a week. Then I'm going to give you the options also, and you'll already know that you're going to buy more stock with that. It doesn't have to be the same stock. Some people ask me, well, should I take this money and start buying another stock? Yeah, you can. You can really do that too. There's endless possibilities with this, but the main thing is to get grounded and to get some traction right out of the gate, and this is exactly how we're going to do it. So I'm very excited that you joined us for this Wealth Triangle Report. I hope you're as excited about being in the class as I am having you in the class. This is something I do personally. I know it works. I'm pretty sure it's going to work for you too, and I'm going to do everything possible with you to help you make it work. So this is Jack, and I'm excited you're here, and we'll get started real soon.